Hey, it's Soleil, and this is episode 23 of the Red Pilled Orange Pill Investor, and this is how I start every day.
That's when it just clicked in my mind that if you just run through somebody's face, a lot of people ain't gonna be able to take that over and 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 over again. They just not gonna want that.
Think there's a deeper metaphor there?
Run through a motherfucker face. Then you don't have to worry about them no more.
All right. And why does that remind me of selling covered calls? I do it every week. So these buy and hold people, they buy stocks one time and they just hold it forever. There's just one transaction, and then I suppose there'll be one more transaction if they ever cash out when they're a million years old or something. But I sell a covered call this Friday, and I sell it again next Friday, and next Friday, and next Friday, and next Friday, and I get 1% and 1%, 1% over and over and over and over again. So maybe I should call selling covered calls beast mode style or something. And that's the way I think about it. In Atomic Habits, he talks about how if you get 1% better every day, where's my calculator? So if you get 1% better every day, that's 1.01 raised to the exponent of 365, you'll be 37 times better than you were a year ago. However, stock market doesn't have daily expiration 7 days a week, so apparently the SPY has daily expirations, so it'll be interesting to see what can be done with that. But having 52 expirations a year still allows you, if you get 1% better every week, you should be able to improve by 68% in 1 year. And that's a hell of a lot better than any of the ETFs that I'm aware of. Now, if you buy 100 shares of stock, and this is up 1.67, so you have 167. I guess it would. So this is assuming that you're going to get 1% on 1%, but technically, if you're only buying one share a week, you would have 152 shares at the end of the year, which would still have you up 52%. You don't actually get to collect 1% on 1% until you have 10,000 shares, and then you can buy another 100 shares with the premium that you sold. So you're not going to get 67% until you get, I call it critical mass of the, something, and really it doesn't even have to be 10,000 shares of a small stock. If you've got 100 shares of a large stock, and the premium from that allows you to sell, like HUT is 630. So as long as you're collecting $600 a week, you could buy another 100 shares of HUT every week. I think you could get that. I think the cover calls on Tesla was selling for like 200. So you'd have to have 300 shares of Tesla. MicroStrategy is like $1,000 a week. So you could buy, depending on how greedy you get with the premium, you might be able to buy 100 or 200 shares. But that's a lot of money. The point is, if you all you have is enough for 100 shares of HUT, you can still do this because you can collect. This is already Tuesday, so this isn't even a full week of premium. But at the money, you could get 29 cents, which is about 5%. Going up to 7, you could get almost 2%. So you could sell the $7 strike, and then buy another share of HUT. Now you're going to have 101 shares of HUT. And after a year, you'd have 152 shares of HUT. So that doesn't necessarily mean that the value of your account will be up 52%, because if the value of HUT drops by 20%, you'll have 152% of $4 or something, which would be break even. But the value of HUT could also go up, so you might have 152 shares of HUT, and maybe HUT's $10. So you can actually do better than 52% a year. And so what really is happening? What is the strategy all about? The only Greek that's really important here is theta, to understand what's happening. Theta is the amount that that the cost of this option is going to change per day. So there's, so Tuesday, Wednesday, Thursday, Friday, there's 4 days, which is about 4 times 6 cents is 24. What's the point two? Yeah. So 6 cents of this, well, some of this is based on the value of the value of the stock too, because this is 18 cents under 650, so maybe there's really only 11 cents of theta. Anyway, every day the value of this options contract changes by 6 cents every day, and by the time, if the price of HUT was exactly 650 on Friday, then it would just be zero. This would not be, it would be completely worthless if you're selling a covered call. If you sold the 650 and the price of HUT on Friday is $7, then right before expiration, this $7 strike would be worth 50 cents, because all the theta is gone, and the only value left is the difference between the price of the stock and the strike. But since there's 3 days before expiration, there's uncertainty. Nobody knows if the price of HUT's going to go up or down, so there's some extra value built into the price of this contract that disappears every day as it approaches expiration. And when you're selling a covered call, you are collecting the money that's drying up from this contract every day. And then the hope is that you'd be able to just buy it back for a penny on Friday, because all of the value has drained out of it. So you sold it when it had value, and as long as the price doesn't go over your strike, it expires with no value, and you basically just get to keep the theta that you collected every single day of the contract. So that's how it works. But I mean, why would anyone be on the other side of the trade if everyone can just sit here and collect theta, just sell covered calls on things? It's because that's too fucking boring for most people. So, I was having a sauna conversation with a couple of young guys, and they're on their phones and they're looking at Robinhood, and they're like, "Oh yeah, I'm buying all these options and I never make any money." And I'm like, maybe that should tell you something. Maybe you shouldn't buy options anymore. Maybe you should sell them, since that seems to be, if you're buying options and all you're doing is making the other guy rich on the other side of the trade, maybe you should just do the opposite of that. But I'm not a financial advisor, so this is all just for entertainment purposes. However, what makes sense to me and what I do is, whereas the other person, can get lucky. And the reason why people do it is because you have infinite this little chart will pop up if you say, oh, I want to buy the 6.5 call. Okay, well, if you can't read this, it says that the price at expiration could be unlimited. Because if the price of HUT shot up to $1 million or infinite money, then this option would be worth infinite money and you would have won the lottery. However, that almost never happens, and usually people that buy calls just end up with nothing at expiration. I think statistically most calls expire worthless. So when I sell a call, they're almost always expiring worthless. So in almost every single case, I'm going to sell this and then buy it back for little to nothing. You can just let it expire if you want, but usually I don't have time for that. I want to roll my calls on Friday, so I'll buy it back for a penny or two or whatever. But in the event that HUT does go to 10 or 20 or 50 or 100 or whatever, and if you sold this naked, meaning you didn't own the shares, you'd be exposing yourself to infinite risk because you'd be on the hook to go out there and buy those shares. However, when you own the shares, then, if you sold the $7 strike, you'd get the 65 cents between 6.35 and 7. And then if it was $50 a share, you'd just have to turn over your 100 shares to the person on the other side of the contract, and then they're throwing a party because they bought this call from you for 30 cents, and then they just made $5,000 or whatever. So that's why people do it. They're going down to the corner store and buying lottery tickets, and that's not what I do. I'd rather just collect theta every day, own the shares, so I'm doing it safely, and then when you run through a motherfucker face, then you don't have to worry about them no more. All right, with that, be good, Joe.